Building a diverse asset portfolio is a critical strategy for managing risk and ensuring long-term financial stability. Diversification involves spreading investments across various asset classes, industries, and geographies to minimize the impact of poor performance in any single area. Here's the ultimate guide to help you build a diverse asset portfolio that can withstand market fluctuations and achieve your financial goals. Number 1. Understand the importance of diversification. Diversification is a risk management strategy that blends various investments within a portfolio to mitigate risk. A diversified portfolio typically includes a mix of stocks, bonds, real estate, and other asset classes. The goal is to achieve higher returns and lower overall risk compared to any single investment. By spreading investments across different asset classes, you can reduce the volatility of your portfolio and protect against significant losses during market downturns. Diversification allows investors to benefit from the potential growth of different sectors and industries while minimizing the impact of any individual investment's poor performance. Overall, maintaining a well-diversified portfolio is essential for long-term financial stability and success. Number 2. Assess your risk tolerance. Before embarking on portfolio construction, evaluating your risk tolerance is paramount. Risk tolerance signifies your willingness to endure fluctuations in investment returns. Influential factors encompass age, income, goals, and financial commitments. Typically, younger investors with ample time ahead may embrace higher risks, aiming for potential higher returns. Conversely, individuals nearing retirement often favor conservative investments to safeguard their accumulated wealth. Assessing your risk tolerance ensures alignment between your investment strategy and personal financial circumstances, fostering a balanced approach to wealth accumulation and preservation. Number 3. Allocate assets strategically. Asset allocation is the practice of spreading investments across various asset categories like stocks, bonds, real estate, and cash. This strategy should match your risk tolerance and investment objectives. A popular approach is the age-based allocation rule, where you subtract your age from 100 to decide the percentage of your portfolio allocated to stocks, with the rest in bonds. For example, a 30-year-old might have 70% in stocks and 30% in bonds. This method aims to balance potential returns with risk as you progress through different stages of life, providing a framework for building a diversified and resilient investment portfolio. Number 4. Diversify within asset classes. Diversification goes beyond asset allocation within each asset class. Diversifying your holdings is crucial. In stocks, diversify by investing in domestic and international stocks, large cap and small cap companies, and across sectors like technology, healthcare, and consumer goods. Similarly, in bonds, opt for a mix of government, corporate, and municipal bonds with different maturities. This strategy helps spread risk and maximize potential returns, as different assets perform differently under various market conditions. By diversifying within asset classes, investors can build a resilient portfolio that withstands market volatility and aligns with their long-term financial goals. Number 5. Consider alternative investments. Alternative investments, such as real estate, commodities, hedge funds, private equity, and collectibles, offer additional diversification and the potential for higher returns. While they can enhance portfolio diversification, these assets typically come with higher risks and less liquidity. Therefore, it's crucial to strike a balance and allocate them appropriately within your investment portfolio. By carefully considering the risk-return profile of alternative investments and integrating them thoughtfully with traditional asset classes, investors can create a well-rounded portfolio that maximizes potential returns while managing risk effectively. Number 6. Use low-cost index funds and ETFs. Index funds and exchange-traded funds ETFs offer cost-effective diversification by tracking specific indices like the S&P 500. Passively managed, they boast lower fees compared to actively managed funds. Incorporating a blend of index funds and ETFs into your portfolio ensures broad diversification with minimal effort, making them valuable tools for investors seeking to spread risk across various asset classes. With their simplicity and affordability, these funds empower investors to build a well-rounded portfolio that aligns with their investment objectives and risk tolerance, providing access to a wide range of assets without the need for extensive research or active management. Number 7. Regularly rebalance your portfolio. Regular rebalancing is crucial for maintaining a balanced portfolio. As the value of your investments fluctuates, your asset allocation can deviate from its target. Rebalancing involves adjusting your portfolio periodically to realign it with your original or desired asset allocation. Whether done annually, semi-annually, or quarterly, this practice helps manage risk and ensures your investments stay aligned with your goals. By staying disciplined with rebalancing, investors can mitigate the impact of market volatility and maintain a diversified portfolio that supports their long-term financial objectives. Number 8. Invest in dividend-paying stocks. Investing in dividend-paying stocks offers a reliable income source and bolsters portfolio stability. These stocks are typically from companies with consistent earnings and solid financial standings. By diversifying with a blend of high dividend and growth-focused stocks, investors can augment portfolio performance while mitigating risks during market downturns. The steady income from dividends cushions against market volatility, providing investors with a consistent cash flow regardless of market conditions. Additionally, reinvesting dividends can compound returns over time, further enhancing the long-term growth potential of the portfolio. Number 9. Incorporate fixed income investments. Fixed income investments, such as bonds and certificates of deposit CDs, offer stability to portfolios through regular interest payments. They typically exhibit lower volatility compared to stocks, making them valuable for capital preservation. A diversified portfolio benefits from a range of fixed income securities encompassing different maturities and credit ratings. By including a mix of bonds and CDs, investors can mitigate risk while ensuring consistent income streams. Whether seeking steady income or balancing against more volatile assets, incorporating fixed income investments is essential for building a resilient portfolio that can weather market fluctuations. Number 10. Explore global investments. Investing in global markets can further diversify your portfolio by reducing dependence on any single economy. Allocating a portion of your portfolio to international stocks and bonds, including emerging markets, can provide exposure to different economic cycles and growth opportunities. This global diversification can potentially enhance returns and reduce risk by balancing out the performance of various regions. By investing internationally, you can tap into growth opportunities that may not be available in your home country, while also mitigating the impact of local economic downturns. This approach creates a more resilient and well-rounded investment strategy. Number 11. Monitor economic and market trends. Staying informed about economic and market trends is crucial for making informed investment decisions. Monitor factors such as interest rates, inflation, and geopolitical events that impact various asset classes. While it's essential to avoid impulsive reactions to short-term market fluctuations, understanding broader trends helps you adjust your portfolio strategy when necessary. This knowledge allows you to capitalize on opportunities and mitigate risks, ensuring your investments remain aligned with your financial goals and market conditions. Keeping a long-term perspective while staying updated on relevant trends can significantly enhance your investment strategy's effectiveness and resilience. Number 12. Utilize tax-advantaged accounts. Maximizing tax-advantaged accounts like IRAs, 401ks, and HSAs can optimize your portfolio's performance by minimizing tax burdens. Contributions to these accounts offer immediate tax benefits, while investments grow tax-deferred or tax-free. Seizing employer-matching contributions in retirement accounts is crucial, as it translates to free money, amplifying your retirement savings significantly. By strategically leveraging these tax-advantaged vehicles, investors can not only reduce current tax liabilities, but also compound wealth more efficiently over time, securing a stronger financial future. Number 13. Seek professional advice. Building a diverse asset portfolio can be complex, and seeking professional financial advice. Building a diverse asset portfolio can be complex, and seeking professional financial advice can provide valuable insights and guidance. A financial advisor can help you develop a customized investment strategy based on your risk tolerance, goals, and financial situation. They can also assist with rebalancing, tax planning, and navigating market volatility. With their expertise, you can make informed decisions, optimize your portfolio's performance, and work towards achieving your long-term financial objectives. Consulting a financial advisor can give you the confidence and peace of mind to navigate the complexities of investing and build a resilient portfolio tailored to your needs. So, what do you think of our video? Let us know in the comment section below. If you enjoyed this video and want to hear from me again, be sure to hit that subscribe button before you go. Thanks for watching.